Most people think a recession is the biggest economic threat they will ever face. They hear the word recession and imagine job losses, falling stock prices, and businesses struggling to survive. But what if the real danger isn't a recession at all? What if the next economic challenge is something much larger, something deeper, and something that affects every American household regardless of income level? That's what I want to talk about today. When people look at the economy, they often focus on short-term events. They watch interest rates, inflation reports, stock market movements, and employment numbers. These indicators matter, but they don't tell the full story. To understand where we are today, we need to zoom out and look at the bigger picture. Throughout history, nations have gone through long-term cycles. These cycles involve debt, wealth, power, productivity, and social stability. When these cycles become stretched too far, the consequences can be much more significant than a typical recession. Today, the United States is carrying an enormous amount of debt. Government debt continues to grow. Corporate debt remains high. Consumer debt is reaching levels that would have seemed unimaginable decades ago. Credit cards, mortgages, auto loans, student loans. Americans are increasingly dependent on borrowed money to maintain their lifestyles. Debt itself is not necessarily a problem. In fact, debt can help economies grow when used productively. The problem begins when debt grows faster than income and faster than economic output. Imagine a family earning $80,000 a year while spending $100,000. They can do that for a while by borrowing money, but eventually, lenders become concerned. Interest costs rise. Debt payments consume more of the family's income. At some point, the system becomes unsustainable. The same principle applies to countries. Nations can borrow for many years, but eventually the burden becomes difficult to manage. What makes today's situation unique is that many governments around the world face similar challenges at the same time. Debt levels are elevated globally. Economic growth is slowing in many regions. Populations are aging. Productivity growth is not keeping pace with historical averages. These factors create pressures that cannot be solved easily through traditional economic policies. When recessions occur, central banks typically lower interest rates. Lower rates encourage borrowing and spending. This often helps stimulate economic activity. But what happens when debt is already extremely high? What happens when lowering rates no longer produces the same results? Policymakers have fewer tools available. The economy becomes more fragile. Another issue is inflation. For decades, many Americans enjoyed relatively stable prices. Today, however, inflation has reminded people how quickly purchasing power can disappear. Even if inflation slows from its peak, the prices people pay rarely return to previous levels. Housing, healthcare, insurance, education, and groceries continue to consume larger portions of household budgets. Many families feel as though they are working harder but getting less in return. This creates a dangerous psychological shift. When people lose confidence in their financial future, they become less willing to spend, invest, and take risks. Economic growth slows further. Businesses become cautious. Hiring slows. The cycle feeds on itself. But economics is only part of the story. Historically, financial stress often leads to social and political tensions. When wealth gaps widen and opportunities become less accessible, frustration grows. People begin looking for someone to blame. Political divisions intensify. Trust in institutions declines. These patterns have appeared repeatedly throughout history. The challenge is that many people assume today's problems are temporary. They expect conditions to return to normal quickly. But sometimes history doesn't move in straight lines. Sometimes entire systems need to adjust. Those adjustments can take years rather than months. Technology is also transforming the economy at an unprecedented pace. Artificial intelligence, automation, and advanced robotics are increasing productivity while simultaneously creating uncertainty about future employment, while innovation creates new opportunities. It also disrupts existing industries. Workers must adapt faster than ever before. Companies that fail to evolve can disappear surprisingly quickly. At the same time, global competition continues to intensify. Emerging economies are becoming stronger. Technological capabilities are spreading. Supply chains are shifting. Economic power is becoming more distributed across the world. The dominance that certain countries enjoyed for decades may not look the same in the future. For investors, this environment requires a different mindset. Many people assume that what worked during the last 20 years will continue working indefinitely. History suggests otherwise. Markets move in cycles. Asset classes move in cycles. Economic leadership changes over time. Flexibility becomes increasingly valuable. One of the biggest mistakes people make is confusing temporary prosperity with permanent prosperity. During good times, risk often appears invisible. People become comfortable. They assume growth will continue forever. Yet history repeatedly demonstrates that periods of stability often plant the seeds of future instability. This does not mean disaster is inevitable. It means preparation matters. The individuals who navigate uncertainty successfully are usually not the smartest or luckiest. They are the most adaptable. They focus on resilience rather than prediction. They understand that nobody knows exactly what will happen next. Building resilience starts with financial discipline, reducing unnecessary debt, maintaining emergency savings, investing consistently, and developing valuable skills all increase flexibility. These actions may seem simple, but they become powerful during periods of economic stress. Another important principle is diversification. Whether we're discussing investments, income sources, or skills, concentration creates vulnerability. Diversification creates options. When conditions change, options become extremely valuable. People often ask whether a recession is coming. The more important question may be whether society prepared for a world that looks different from the one we've known. Economic transformations rarely announce themselves clearly. They develop gradually and then appear sudden in hindsight. The reality is that every generation faces major transitions. Previous generations experienced world wars, inflation crises, technological revolutions, and financial collapses. Today's generation faces its own unique challenges. The objective is not to fear those challenges, but to understand them. If history teaches us anything, it is that cycles eventually change. Debt cycles change. Political cycles change. Economic cycles change. The individuals who recognize these shifts early have a significant advantage. They position themselves for opportunities, while others remain focused on the past. What worries me most isn't a recession. Recessions are normal. Economies recover from recessions. What concerns me is the possibility that we are entering a period where several major forces, debt, demographics, geopolitics, technology, and social tensions are converging simultaneously. When multiple pressures build at the same time, the outcomes become less predictable. The future may look very different from what many Americans expect. Retirement planning may require different assumptions. Investment strategies may need adjustment. Career paths may evolve more rapidly. Economic leadership may shift in unexpected ways. Yet uncertainty also creates opportunity. Every major transformation in history produced winners and losers. The difference often came down to preparation, adaptability, and perspective. People who remained flexible discovered opportunities others missed. So, when someone asks whether something worse than a recession is coming, my answer is this: the greatest risk is not a recession itself. The greatest risk is failing to recognize the deeper structural changes taking place beneath the surface. Those changes are already happening. The question is whether we are paying attention. Now let's go deeper. If the risks facing America are larger than a normal recession, what exactly should investors, workers, families, and business owners be watching right now. The first thing to understand is that economies don't collapse overnight. Most major economic problems develop slowly. They build beneath the surface for years before becoming visible to everyone. By the time headlines start talking about a crisis, much of the damage has already been done. That's why understanding long-term trends is so important. One of the biggest trends today is the growing cost of debt. For years, governments benefited from relatively low interest rates. Borrowing was inexpensive. Debt could be refinanced easily. But when interest rates rise, everything changes. Suddenly, servicing debt becomes more expensive. Governments must spend more money on interest payments. Businesses face higher financing costs. Consumers pay more for mortgages, credit cards, and loans. Think about the implications. Every dollar spent paying interest is a dollar that cannot be invested elsewhere. Governments have less flexibility. Businesses become more cautious. Households reduce spending. Economic growth slows naturally under these conditions. At the same time, another challenge is emerging. Many people assume inflation is gone simply because headlines mention lower inflation numbers. But there's a major difference between inflation slowing and prices falling. Most Americans are still paying significantly more for everyday necessities than they were just a few years ago. Housing costs remain elevated. Insurance premiums continue rising. Healthcare expenses increase. Utility bills are higher. Food prices remain a concern for many households. Even if inflation appears under control statistically, the financial pressure on families remains real. This creates what I call the affordability problem. People may still have jobs, but they feel poorer. Their paychecks don't stretch as far. Savings rates decline. Financial stress increases. Over time, this affects consumer behavior and economic confidence. Confidence is one of the most important forces in any economy. Modern financial systems operate largely on trust. People trust that banks are stable. Investors trust that markets will function. Consumers trust that their money will retain value. Businesses trust that demand will continue. When confidence weakens, even healthy systems can experience stress. That's why policymakers pay close attention to sentiment indicators. Confidence influences spending, investment, and risk-taking behavior. Now let's discuss another issue that receives less attention: wealth inequality. Throughout history, periods of significant inequality often coincided with social and political instability. When large portions of the population feel left behind, tensions rise. This doesn't mean success is a problem. The issue emerges when economic opportunities become increasingly uneven. If people believe hard work no longer leads to meaningful progress, frustration grows. That frustration eventually influences politics, policy decisions, and economic outcomes. History provides many examples. Nations that successfully managed periods of inequality often focused on expanding opportunity, increasing productivity, and maintaining social cohesion. Nations that failed to address these challenges frequently experienced deeper instability. Another trend worth watching is demographic change. Population dynamics influence nearly every aspect of economic performance. Younger populations tend to spend, invest, and build. Older populations tend to save more and spend differently. Many developed countries are facing aging populations. This creates pressure on healthcare systems, retirement programs, and government budgets. Fewer workers support more retirees. Growth slows naturally unless productivity increases significantly. Technology could help solve some of these challenges. Artificial intelligence has the potential to increase efficiency dramatically. Businesses may become more productive. Certain costs could decrease. Entire industries may transform. However, technological revolutions are rarely smooth. They create disruption before creating stability. Some jobs disappear. New jobs emerge. Workers must adapt. Education systems must evolve. Businesses must rethink traditional models. Throughout history, societies that embraced innovation while helping workers transition generally performed better than societies that resisted change. The challenge is balancing efficiency with opportunity. Geopolitics represents another critical factor. The world is becoming increasingly competitive. Economic power is shifting. Strategic rivalries are intensifying. Trade relationships are evolving. For decades, globalization helped reduce costs and improve efficiency. Companies built supply chains that stretched across continents. Consumers benefited from lower prices. Businesses increased profits. Today, however, resilience is becoming more important than pure efficiency. Governments and corporations increasingly prioritize security, reliability, and domestic production. This transition can be expensive. It can also contribute to inflationary pressures. Meanwhile, financial markets continue sending mixed signals. Some investors remain highly optimistic. Others are increasingly cautious. Asset prices in certain areas appear elevated relative to historical norms. Whenever valuations become disconnected from fundamentals, risk increases. That doesn't necessarily mean a crash is imminent. Markets can remain expensive for extended periods, but investors should remember that high expectations create vulnerability. When expectations are extremely optimistic, disappointments can have outsized effects. This brings us to a concept that many people misunderstand: risk. Most investors think risk means volatility. They worry about market fluctuations. They worry about daily price movements. True risk is different. True risk is the possibility that your assumptions are wrong. It's the possibility that the future unfolds differently than expected. Managing risk means preparing for multiple outcomes rather than betting everything on a single forecast. The most successful investors in history rarely relied on certainty. They relied on probability. They understood that nobody can predict the future consistently. Instead, they built portfolios capable of surviving various scenarios. The same principle applies to personal finance. Economic resilience matters more than economic prediction. Nobody knows exactly what inflation will be next year. Nobody knows where interest rates will be. Nobody knows which industries will dominate 10 years from now. What people can control is preparation. They can reduce unnecessary debt. They can improve skills. They can diversify income sources. They can maintain financial flexibility. Flexibility may become one of the most valuable assets of the coming decade. In rapidly changing environments, adaptability often outperforms specialization. Individuals who continue learning and evolving place themselves in stronger positions. One lesson I learned from studying hundreds of years of history is that people consistently underestimate change. They assume tomorrow will resemble today. They project recent experiences into the future. Yet the biggest transformations often occur when people least expect them. Consider previous generations. Many couldn't imagine the technological world we live in today. Others couldn't imagine the collapse of systems they believed would last forever. Change frequently arrives faster than expected. This is why understanding cycles matters. Debt cycles, political cycles, technological cycles, and market cycles all influence each other. When multiple cycles reach turning points simultaneously, significant transitions can occur. Today, we may be witnessing one of those moments. That doesn't guarantee crisis. It doesn't guarantee prosperity either. It simply means the environment is becoming more complex. Environments reward thoughtful decision-making. They reward patience. They reward preparation. They punish complacency. Many Americans are asking what they should do right now. My answer is straightforward. Focus on what you can control. Build financial strength. Continue learning. Stay informed. Avoid emotional decision-making. Maintain perspective. Fear can be just as dangerous as overconfidence. During uncertain periods, some people become paralyzed. They stop investing. They stop planning. They stop pursuing opportunities. That reaction often creates long-term problems. The goal is not to fear change. The goal is to understand it. Every economic transformation creates opportunities alongside challenges. New industries emerge. New technologies create value. New solutions solve old problems. The future will likely reward those who remain adaptable. It will reward those who think independently. It will reward those who prepare for multiple possibilities rather than relying on a single prediction. So when I ask whether something worse than a recession could be coming, I'm not talking about one event. I'm talking about a collection of long-term forces that are reshaping the world simultaneously. Debt pressures, demographic shifts, technological disruption, geopolitical competition, social change. These forces will influence markets, careers, governments, and households for years to come. The good news is that history also teaches us something incredibly important. Human beings are remarkably resilient. Societies adapt. Businesses innovate. Individuals find solutions. Challenges create progress when people respond intelligently. The future is not predetermined. It depends on the choices we make today. The people who understand the risks, prepare thoughtfully, and remain flexible will be in the strongest position regardless of what happens next. Because in the end, the biggest threat isn't a recession. The biggest threat is being unprepared for a world that is changing faster than most people realize. And the biggest opportunity belongs to those who see that change coming before everyone else does.